Hello traders, hello everyone. Welcome to the advanced room here at Life Education with XM and welcome to our session. This time it's me and Andrew. We are going to talk about markets. We are going to see what is the situation on the market. Wednesday, middle of the week, pretty important events are ahead. I mean, central banks quarterly meetings, but are there any other important news? We have to check it. Hello, Andrew. How is it going? How is the week for you?
Hello, Martin. Good morning, our regular viewers, and also special hello to our YouTube viewers joining for the preview. Later, the session would continue as normal. Yes, yesterday very sleepy session. Looked like a holiday. Probably the silence before the storm upcoming week. Bunch of important data. I mean, CPI. Actually, I single out one piece of data. It's CPI from United States on Tuesday, 13th of June. And then you have the first day of FOMC meeting, and then you got a second day of FOMC meeting on Wednesday with the decision, which is probably not that full of surprises. Probably they're going to be flat with a rate, but you never ever know. But there will be conference call. And projections are they coming? From time to time, FOMC is producing quarterly projections. I think every quarter they produce those quarterly projections with the outlook for upcoming years when it comes to the unemployment rate, inflation levels, as measured by the PCE inflation, interest rate levels, and GDP. So that will be very interesting to see if they change their outlook as compared with previous projections, which of course moves the market again. Which market? Stock market, gold market, bond market, dollar, which means forex market. Basically 90% of markets maybe wouldn't move much of a soybean market or coffee market, but definitely most of those instruments that we see and trade are gonna be moved by the CPI and then the FOMC. As for today, Bank of Canada central bank decision, flat rate expected, probably no surprises. However, the conference call, as always, very important with outlook from Bank of Canada itself. And right now, Canadian dollar is making new intraday lows. So strength of Canadian dollar continues. I will see if this is going to change during the Bank of Canada later, a couple hours from now, actually, in the morning of Canadian session. So very sleepy markets, gold very tight consolidation in $10 consolidation yesterday. Today reached 55, bouncing back into 60s. Altogether yesterday between 65, 55, kind of a $10, half of the normal volatility we observe. So definitely there's some kind of consolidation in suspense mode before the next week CPI and FOMC.
Well, interestingly, the market is very calm. For example, we've seen yesterday Aussie being strong, like exceptionally strong on forex market. In general, VIX is at lows not seen, I guess, from COVID. VIX is at 15 right now. Yesterday was even slightly lower. Yeah, those are new lows, because the low from post-COVID during post-COVID time was 16.21, something around that. Now we are around 15.6. So this is the market that's optimistic somehow, not really, or not pessimistic. So either neutral or optimistic, which is a little bit against many people's views that the recession is coming, all the bad things are coming, and so far it looks like banking crisis has been put down. The fire has been put down. The problem with debt ceiling has been solved as well. There is nothing to fear about at the moment, at least according to VIX index, of course. So yeah, and market is calm. Yesterday, interestingly enough, Reserve Bank of Australia, which was one of the first hawkish banks to pause interest rates increases, because not every central bank is very hawkish, but among G8, you have Bank of Japan that is actually still dovish. You have Swiss National Bank, which is very cautiously hawkish. I don't know if you can even call it hawkish, but maybe going from dovish to neutral is better word. But you have Reserve Bank of Australia that was hiking interest rates and tightening monetary policy, and out of a sudden they said, okay, we have to pause. Things are not looking great overall. We think inflation gonna come down, so we pause. And recently they surprised. So recently, yesterday, they surprised the market with higher interest rate. So there is this. I think there is this feeling, this message that other central banks may also become more hawkish than initially markets were thinking. So here, Bank of Canada comes. Like in many aspects, Canada is similar. Canadian dollar is similar to Australian dollar. In many aspects, it's also similar to US dollar. And both Fed and Reserve Bank of Australia recently are expected to be more hawkish. You know, like everybody is thinking that Fed should stop, right? And that was the expectation, that Fed will stop very soon with the interest rate increases, and they maybe even start lowering interest rates September or December. Right now, the market sort of revised that thinking, pushed back into the future, or forward into the future, possible rate decreases, and now everybody is thinking how much will Fed increase interest rates, how much further will they increase. So very interesting situation, and maybe difficult in a sense, right? Because how do you commit if you don't know to which side you should lean? Either you should lean towards Fed pivot, or and you have inflation coming down recently, especially in Europe. We have PMIs this week. We had, actually, that's surprising that they didn't move the market too much. Good PMIs for US, especially good for services, but manufacturing is weaker. Very good, not so good for Europe typically. So everybody's waiting for the recession. Is the recession coming? I don't know. I'm leaving this question open. What are you looking at, Andrew, right now? What are you focused on?
Yeah, there was lots of talk about recession. Tax market is flat for 2 months. Nothing really happens there. S&P
No
is
recession
flat.
on tax.
So actually, I think there is a more risk in the market that you might be perceiving. So VIX going down at the level we didn't see since 2021. Last
Exactly.
year,
It's like the opposite, right? The more of bad news in the media, the lower the VIX is going. No.
Yeah, but also VIX is going down because there is not much coming in the not happening market. So because they observe the present volatility, which came down compared to 2022, and they presume that the current low volatility might be projected into the future. And that's why the VIX is low. So they're looking at the current volatility, and it's kind of natural to assume, all right, probably nothing really will be happening within 1 month or so. And VIX is a measure of expected volatility 1 month from now, right? So we look at the expected volatility, not the current volatility. And that's where there might be the fallacy of that premise, that where something starts to happen, the market is really poised to drop fast, and then VIX will go up fast from 15 into, let's say, 20, 25. Right? Usually when you have lower VIX, when you have fear index at very low level, that's the moment when actually something might be happening. We
So
saw that before.
you should be fearful when there is greed, right? When there is no fear on the market.
Right. You have to be opposite. VIX is always opposite indicator. So whenever I see low VIX, I say, guys, we have to wait for pullback, don't buy stock. actually you can be selective in buying some stocks. They can still be flat or going up in the meantime. But talking about the stock market index, which is kind of average and reflects the overall equilibrium and taking into account various macro factors, that stock market itself uh, might be more risky than you really think that it is. When you look at the current volatility, fear index, and actually you look at the prices, you see not much of a change. And you can have a negative catalyst. But the question is, what would be the negative catalyst for the market's significant drop? First class of factors is unpredictable factors that they can come suddenly and that will become the risk. So you have to be always eyes open, ears open on, all right, something happened. Is it very drastic? Is it dramatic? Is it really going to change the market? Like the virus, whole February, like we heard about the virus in Wuhan. Still, the DAX was making the new historic highs back in February, somewhere 20 of February 2020, and S&P was making new highs. And we already like 1 month into this virus situation. Starbucks was closing stores, Apple was closing stores. Still, the stock market was up, unbeat. They are resilient. And then suddenly you see things changed, right? So always you have to be on the lookout. So those are the category.
So it can come by surprise, right?
Right. And then you have some situation that you might be predicting. Let's say geopolitical situation right now looks like it's stable. Anytime you can hear something very negative from this Russia-Ukraine conflict. Anytime. It's still on the way, right? But market accustomed to that. Last year, you got this geopolitical Russia-Ukraine conflict because there was something new. Nobody knew how it's going to actually conclude itself. You had volatility like 35, an average on 25. Right now, you have like half of that. And still, you are in that conflict, right? Because market accustomed to that.
Yeah, everybody's hedged, right? Not exposed to that anymore. And this situation is already taken into account everywhere, wherever it's necessary to take it into account. Let me welcome our viewers in the chat. Xavi, Kangelani, welcome. Nakalembe, also welcome. Thank you for joining. Nakalembe says, I would like to know a good strategy to use on US 30. And I'm also seeing that soon our YouTube preview will be finishing. So we will be continuing on the XM website, guys. You will probably find the link in the description on YouTube. So follow it, go to the XM website, and you can watch us further. So how would you approach US 30 at the moment?
First, you have to, hello, Nakalembe. First, you have to know what kind of instrument you're trading, right? So, I mean, what is US 30? US 30 is a kind of a number that comes up in your screen. Is up or down, right? But 10 points, 100 points, 300 points, sometimes more, sometimes less. But what actually is US 30? What is DOL 30? It's not the price of a stock. It's not even, yeah, we can say this is the price of a set of 30 stocks, which is average. It could be the one stock goes up, another stock goes down. This is the price weighted index, means that the stock which is more expensive affects more the price of the index than the stock which is less expensive. But you're still dealing here with the average, right? So you can have some kind of macro factors that are driving the whole average down, means that most of the stocks will go down. So you will know, all right, this might be the bear market. So actually you'll be biased to the downside. You can have a bullish market when the most of stocks go up. That's the average, like DOL 30. In the meantime, when you have equilibrium, when the market consensus is to be aware of all negative and positive, and it's finding itself in equilibrium, you're looking at, or the market looking at some technical levels, because this is the average. This is just the index. So you have to apply, most of the time, you have to look at the technicals. So I would say that the 70%, that will be technicals. Of course, you have to understand 30%. You have to understand what's driving the market. Is the market bullish, bearish, or it's got out from the bearish stage like we are right now, and it's consolidating because maybe it's too expensive, fundamentally speaking, compared to the free risk asset, which is bearing 5%.